3 years ago, most of Wall Street laughed at Bitcoin. Large banks called it a bubble. Famous investors said it would eventually go to zero. Television analysts dismissed it as nothing more than internet money. Back then, very few institutional investors wanted anything to do with crypto. But today, the conversation has completely changed. The same financial giants that once criticized Bitcoin are now offering crypto investment products. Major asset managers are competing to attract Bitcoin investors. Banks are building digital asset divisions. And governments around the world are discussing crypto regulations. So, what happened? Why did Wall Street change its mind? And more importantly, what does that mean for ordinary investors? Welcome to Capital Mindset. Let's find out. To understand what's happening today, we first need to go back. When Bitcoin was created in 2009, almost nobody believed it could become a global financial asset. It was mainly used by technology enthusiasts, developers, and a very small online community. Traditional finance ignored it. Banks didn't understand it. Governments barely talked about it. As Bitcoin slowly gained popularity, its price became extremely volatile. Huge rallies were followed by massive crashes. This volatility reinforced the belief that Bitcoin was too risky for serious investors. Wall Street preferred traditional assets, stocks, bonds, real estate, gold. Bitcoin simply didn't fit into their investment models. But then, something unexpected happened. Year after year, Bitcoin refused to disappear. Despite multiple crashes, it continued attracting new users. More developers entered the ecosystem. More businesses started accepting digital assets. Infrastructure improved. Security improved. Institutional custody solutions appeared. Little by little, Bitcoin started looking less like an experiment and more like an emerging financial asset. Then came one of the biggest turning points in crypto history. Institutional investors began paying attention. Large companies started adding Bitcoin to their balance sheets. Investment funds explored crypto exposure. Financial advisors received increasing numbers of questions from clients. People no longer asked, "What is Bitcoin?" Instead, they asked, "How much Bitcoin should I own?" That single change completely transformed the conversation. Demand was no longer driven only by retail investors. Professional investors entered the market. And when institutional money starts flowing, Wall Street notices. But perhaps the biggest milestone came when spot Bitcoin ETFs entered the picture. For years, many believed a spot ETF would never receive regulatory approval. The process was long, complicated, and filled with legal debates. Yet eventually, the landscape changed. Suddenly, investors could gain exposure to Bitcoin through familiar investment products, without creating crypto wallets, without managing private keys, without learning complicated blockchain technology. Everything became simpler, and simplicity attracts capital. This is one of the biggest lessons in finance. Money usually follows convenience. When investing becomes easier, more people participate. That doesn't guarantee higher prices, but it often increases interest. Today, some of the world's largest asset managers offer Bitcoin investment products, not because they suddenly became crypto enthusiasts, but because clients are asking for them. Demand creates supply. Wall Street follows demand. Not emotions, not opinions. Business. And business is exactly why Bitcoin has become impossible to ignore. But here's something many people misunderstand. Institutional adoption does not eliminate risk. Bitcoin remains a volatile asset. Prices can rise quickly, and they can fall just as quickly. Markets continue reacting to economic data, interest rates, inflation, global liquidity, and investor sentiment. Crypto has matured, but it has not become risk-free. That is why successful investors focus on long-term strategies rather than daily headlines. They understand that volatility is part of emerging markets, and they avoid making emotional decisions based on short-term price movements. So, what happens next? No one knows with certainty. Perhaps institutional adoption continues accelerating. Perhaps regulations become clearer. Perhaps new technologies make blockchain even more useful. Or perhaps the market enters another difficult period before continuing its evolution. History has shown that financial innovation rarely follows a straight line. Every major technological revolution experienced setbacks. The internet did. Artificial intelligence did. Mobile technology did. And crypto is likely to be no different. The important question isn't whether Bitcoin will experience volatility. It almost certainly will. The real question is whether adoption continues expanding over the next decade. If the answer is yes, then today's developments may simply represent another chapter in a much larger story. Wall Street may have laughed at Bitcoin years ago, but today, it can no longer afford to ignore it. Because whether people love Bitcoin or hate it, digital assets have become part of the global financial conversation. And that conversation is only getting started. If you enjoy objective crypto analysis without hype, subscribe to Capital Mindset. Because every day, we explain the biggest stories shaping the future of money. Thank you for watching. I'll see you in the next video.